Welcome everyone to our Mena session. We have a fantastic speakers. Let me start first saying few words before we kickstart our discussion and move to some questions. The MENA region is now in a new era of prolonged low oil prices. Since the sharp drop in oil prices in 2015, real GDP growth in most of the MENA oil exported shifted from an average around 6-7% from 2000 till 2014 to a range of 2 to 3%, which is not enough to create enough jobs for the new entrants to the labor force. The fiscal surpluses of the previous decade shifted to large deficits, and most of the growth in the past, before the fall of oil prices, was driven by public spending. So now you are in a new environment of prolonged low oil prices that you cannot sustain continued large government spending because you need fiscal consolidation. And that's why most of the countries in the region are attempting to diversify their economies away from oil, encourage the private sector, implement some structural reforms. So we will touch on some of these issues. Given that oil prices will stay low for a while, for at least for the next 3-4 years, according to future prices forecast, the region is facing this dilemma of resuming fiscal consolidation and maintaining a reasonable growth rate between 2 or 3%. Fortunately, in the past 6 months, monetary policy eased. This is helping. We noticed that private sector credit picked up in Saudi Arabia, UAE, and other GCC countries. So let me start first with Tim on the issue of oil, how you see oil prices in the context also of the coronavirus, and how far OPEC Plus can reduce production of oil in order to stabilize oil prices, let's say around 60 or slightly higher than $60 per.
Okay, thank you. Thanks, Garbis. I think our view on oil prices is that the average price for this year is going to be not very far from where we are today, around the 55 mark in WTI terms, in Brent terms around $57. So not a million miles from where we are right now, but obviously the story so far this year has been quite a lot of variety around that level and those levels, and you had the peak around close to 70 in early January, and a trough so far at least just below 50. So clearly a lot of different elements making for quite a lot of volatility in the oil price already, and that is, as you said, having significant impacts on growth estimates for the year so far already, even without any further oil production cuts by OPEC Plus. We revised down our forecast at the start of this year for growth in real GDP growth in GCC countries, in Saudi Arabia down to around 1.5% from 2%. This was just a reflection of the production cuts that were announced at the end of last year. So to the extent that we're now talking about more production cuts, clearly this is going to create more downside risk to growth. And if we're already talking about 1.5% growth, where is it going to end if you keep on cutting oil production in order to jack up the price? And the price has shown itself to be pretty, not necessarily correlated to those production cuts. It's having some impact in terms of stabilizing it, but it isn't really pushing it dramatically higher. Clearly, the coronavirus issue brings another dimension to the debate, and it makes it a complicated one, because as we know with this virus, it's a very fluid situation. We don't know when it's going to end. We certainly don't know where things really are today. and how long it's going to last. So the idea about cutting production straight away would seem, to my mind, a little bit premature, because you've got to have a better sense of where stabilization is going to be in terms of that issue itself. And I think that's probably why the OPEC Plus technical team decided or made a recommendation to cut production, but policymakers decided to wait and to hold off. I think it's sensible to maybe wait a little bit longer before the reality of what the coronavirus actually means for the global economy. But clearly, it probably means weaker demand in China than we had presumed through the rest of this year. Strengthening or recovering demand in China in the second half of the year was one of the key sort of elements behind our sense that maybe oil prices might start to pick up in the second part of the year. But really, as we look at things today, it's very hard to have that sort of more. And I think what we're probably looking at is oil prices, the bigger risks to being on the downside, almost regardless of whether OPEC makes any additional cuts to production. But certainly also those cuts to production, if they do make them, will be a further drag on regional growth.
Yeah, I mean, related to that, IEA recently, they lowered the global demand for oil by almost 500,000 barrels a day. And they are saying that global demand for oil, or the growth in the global demand for oil, will be the lowest since 2010. So in addition to that, you have the glut supply of oil by United States, Canada, and Brazil. So the conclusion is that we will live in an era of prolonged low oil prices. In that context, how you see the risk for some of the oil exporters in the region? Which countries can better than the others?
Well, clearly it's a case of trying to focus and accelerate the focus on the non-oil sides of the economies in the region, and those that have already made advances in terms of diversification probably stand in a slightly better stead than those that are coming from behind. From the UAE's point of view, there is a greater level of diversification. So, and with specific issues and events taking place this year, that gives a kind of a purpose to the year which is beyond oil and separate from oil. I think that's helpful, but it clearly it lends itself to a year in which the non-oil sectors have to come into their own. But unfortunately, when you have trade wars still, I think, still relevant, and also these new pressures on demand, global demand, the non-oil sides will also be dampened as well. So we are looking at pretty significant, I think, falls or revisions to our expected growth rates. And I expect within a few weeks or months, we will be revising lower again our growth expectations.
Yeah, there was recently a study by the IMF showing that under current situation, with oil prices staying, let's say, around 60 or slightly below $60 per barrel for Brent, the countries in the region, or the GCC countries, will deplete their wealth in the sense that the sovereign wealth fund, which is about 2 trillion or 2.5 trillion, will be depleted by year 2034. This is on average. Do you have any comments on this study?
Well, I think we all understand the purpose behind these kind of studies and the kind of arguments that the IMF is making, pushing the diversification agenda, pushing reforms to new taxes, the idea of revenue sources for the region apart from oil, so looking to diversify revenue sources, and looking to rationalize spending plans and consolidate budgets. So these are the sort of measures that the IMF traditionally unfolds and delivers and recommends. So I think their paper is understandable, and it's quite consistent perhaps with their usual recommendations. But it's also quite alarming. kind of paper. I think it clearly with the intention of grabbing attention, of gaining attention, and maybe forcing people to sort of accelerate these processes. I think one of the problems we have with some of the IMF recommendations is the constant pressure on governments to restrain from spending and to rein in budget deficits. Clearly, what we were talking about before is weakening growth, and that is the biggest priority and challenge to this region. And we struggle to find, you mentioned monetary policy has eased. Well, that's kind of a fortunate thing. It's nothing, that was because America's economy was slowing potentially, but that is not in the control of the GCC countries. So GCC countries do need to have control over fiscal policy, and they need to use fiscal policy appropriately to maintain and promote expansions. So we do struggle sometimes with the constant recommendation for the GCC to consolidate budgets and to refrain from spending. Spending can occur if deficits are properly financed, and properly financed means bond issuance and other methods as well, not just winding down reserves.
Yeah. Ziad, before I ask you about the diversification challenges, probably you have some comments on the questions I raised to Tim.
Yeah, on the IMF paper, I think what the IMF paper tries to say is three things that are largely uncontroversial. So it says one thing is that the oil market is being disrupted, and it's being disrupted within the market through the shale oil revolution in the US, but also outside the oil market through renewables and other sources of energy. That's largely uncontroversial. The second thing it says is that given the disruption to the oil market, oil demand will peak at some point. The IMF says 2040. We could disagree about the dates, but I think the trend is there, and I think it's largely uncontroversial as well. And the third thing, which is the conclusion, is that given the outlook for oil demand, the net financial wealth in the GCC, which they use the central bank reserves plus sovereign wealth funds assets minus public debt, will be eroded on average by mid-2030s. And I think also, given the trend that we have seen since 2014, that conclusion, the trend itself is not controversial. We could disagree about the dates, but I think the trend is already there. I think where I disagree with the IMF in two things. I think they've been pessimistic on one thing and optimistic on the other. Where they have been optimistic is that given the sort of the bearish outlook on oil demand, they still assumed oil prices that are $55 in real terms, which is the average that we've had since the 1970s. So they don't assume a decline in oil prices going forward, and that's probably not consistent with the outlook they have for the supply and demand in the oil market. Basically, that assumption means that oil prices will reach $100 per barrel in nominal terms by 2050. Probably that's too optimistic. Where they've been very pessimistic is in their policy recommendation, what Tim has alluded to. So they said, basically, given this outlook, what the GCC countries need to do, they need to cut spending. Diversification by itself won't be enough. And I think that's pessimistic. I think if you have a diversification, if you have new sources of growth in the GCC, you may be able to get away with preserving your financial wealth while not cutting spending so aggressively. They assume non-oil growth will be at 3% going forward. I think with a big drive towards diversification, you could improve that, and that will automatically improve the fiscal arithmetics in the region.
Yeah, I guess the IMF aim is to urge the authorities with fiscal consolidation. But actually, this is happening. I noticed the budget 2020 in case of Saudi Arabia, where you have a drop in spending, further drop. So, and the kingdom is aiming to balance the fiscal budget by 2023. That all depends on oil prices, whether it's 55, 60 or so. But nonetheless, I mean, fiscal consolidation is underway, and that could help. Also, government debt in Saudi Arabia is still less than 30%. So there is much scope to borrow in the international market rather than deplete your reserves or tap your reserves. And the sovereign wealth fund in Saudi Arabia is about 400 billion plus official reserves of 500. In the UAE, you have the total of sovereign wealth fund, which is 800 billion, twice as much as the GDP. In Kuwait, you have 500, 600 billion, 4 times the GDP. So I think I agree with you. It's a little bit more pessimistic view from the IMF, but it has an objective to urge the authorities with fiscal consolidation.
Yeah, and just to add to what you and Tim have mentioned, spending is very important here. Yes, the GCC has slowed down on aggregate since 2014 with a decline in oil prices. But recently we're seeing sort of a two-track of GCC. We're seeing acceleration of non-oil growth in Saudi Arabia. It grew at the fastest rate in 5 years. We're seeing an acceleration of growth in Kuwait. On the other hand, at the other extreme, you have a slowdown in the UAE in terms of non-oil economy. You have a slowdown in Qatar in terms of the non-oil economy. And then in between, you have Bahrain and Oman, who are sort of somewhere in between. And I think one thing you can explain the difference in performance is certainly fiscal policy. You've seen increased spending in Saudi Arabia and Kuwait the last couple of years, and these fiscal stimuli are finally showing up in the growth numbers. Now, the risk is if you start withdrawing this fiscal stimulus, can you sustain growth without higher public spending? That's, I guess, the challenge we're going to see in 2020.
Yeah, one related question from the audience is says, how would a negative, persistent oil price shock, say around $50 per barrel, caused either by weak global demand, mainly China, or return or recovery of crude oil production in Libya, Iran, and Venezuela, affect Saudi foreign exchange reserves? So an environment where you have significantly lower oil prices because of lower global demand for oil and additional supply coming from Venezuela or Iran or Libya.
Well, I suppose the genius answer is that lower oil prices would lead to, it's not good for foreign exchange reserves. But I think what you have here is beyond reserves, is the impact on oil policy. Because since 2017, we've seen oil prices being sustained somewhere, range bound between $55 and $65 per barrel. And if you look at Saudi oil production, if you look at OPEC oil production, this has declined gradually over the last 2 or 3 years. And the question is, how long can you sustain this? You want to maintain oil prices within that range, but increasingly you're losing market share. Do you continue with this strategy, or do you reverse that at some point?
Yeah, Tim, there is another question also on the oil price. The question is, what does a low oil price mean for GCC countries, the different economies, in terms of their budgets? I think he's asking about the fiscal break-even prices of oil for different GCC countries.
No, sure. I think the most exposed countries are the ones that we are aware of, in terms of Oman in particular, which is running a break-even oil price over $100. So under significant pressure if we see that oil price drop below 50, say, that you mentioned.
Yes.
So Oman in particular. Bahrain, less concerned, because Bahrain does have the implicit support of other countries in the region. And then the other countries, more or less, different levels around the sort of 60 to 70 mark in terms of budget break-evens. So I think those are the sort of bare bones numbers that would that you should apply in those to those kind of questions. But Oman and probably Bahrain, probably the most most exposed.
Yeah, and the kingdom, I think it's around 74,
around
75.
The 70s, yep.
And it has come down from last year because of the cut in spending.
Garbis, sorry,
yes.
if I may just add a few comments to Tim on Oman and Bahrain, and tying it as well with the idea of the IMF wealth paper, right? And tying it back to Oman and Bahrain's higher fiscal break-evens. It's going to be interesting to see in terms of response to lower oil prices, to whether Saudi on oil policy also decides to cut oil production, how Bahrain and Oman will be able to sort of juggle this sort of policy response at a time where Bahrain has already embarked on fiscal consolidation. S&P has, at the end of last year, changed the outlook to positive, with the possibility of an upgrade if Bahrain does more than expected on the fiscal consolidation front. Oman also domestically is now transitioning into a new succession, and we're expecting some more sort of changes on the domestic fiscal policy front at a time where we're seeing pressure on oil prices and maybe change in oil policy from Saudi Arabia that will also affect Bahrain and Oman. It's interesting, it's going to be interesting to see whether this is going to accelerate or maybe soften the pace of fiscal consolidation that we've seen already coming out from Bahrain, or whether it's going to accelerate the pace of fiscal consolidation that we're still expecting from Oman as well.
Yeah, coming back to Ziad about diversification challenges in the region. No doubt there has been some progress. Some countries implemented some structural reform, improved the business environment, etc. But nonetheless, I mean, diversification away from oil, it's a long process. How you see the challenges and how you see the progress so far, particularly in the kingdom, because this is one of the main objectives of the Vision 2030.
Yeah. Well, diversification is a tough problem, and it's tough because it's a unique one. We haven't had many cases in history in which countries have been so reliant on a commodity. So we don't have case studies, we don't have ways to understand this. But I suppose there are two tracks to do this. One track, which is what we've seen in the region, which is basically trying to target industries outside oil and gas. The issue with this is that the 6 countries in the GCC who have a similar economic structure, they're basically targeting the same industries. So everyone is moving to petrochemicals to move up the hydrocarbon value chain. Everyone's trying to promote tourism, financial services, logistics, and so on. And the question is then, how many tourist centers do you need in a small geographical area? How many mega airports do you need here? How many ports? And there's an issue of crowding out here. I guess the other way to do it is just to look at, what are the hurdles of doing business in the region and try and address them. And one way to do it is to ask, business leaders here, what are the biggest problems you're facing, and try and address these issues. The World Economic Forum actually does this survey every year. And if you look at the average sort of results from surveys of their businesses in the GCC, you see one thing that's very clear, that the labor market is very problematic in the GCC. Executives here complain about overly regulated labor market. They complain about their inability to find adequately educated workforce, and they complain about work ethic. This is sort of the 3 of the top 5 complaints that we get there. And that's, I think, if you want to diversify, you need to address that. You need to address the labor market. We've seen some steps towards that. In Saudi Arabia, for example, we've seen the decision to allow women to drive. That will increase the pool of labor that's available. We've seen across the GCC a trend to grant long-term residency to expatriates. That's helpful as well. But we've also seen moves towards making the labor market more regulated by increasing nationalization ratios and so on. But I think tackling the labor market is very important if you want to diversify in the long run. But obviously that's a decision, or that's something that is not just economic. It has other dimension as well.
Yeah, one related issue for diversification is to attract enough foreign direct investment. But we haven't seen it in the past 3 years that foreign direct investment didn't pick up significantly, particularly in Saudi Arabia, Kuwait, and Qatar. UAE is one of the highest foreign direct investment, but nonetheless, it's focused more in the energy sector. Yeah. So you need more FDI in the non-energy sector. What's your view on this?
Well, FDI is very important, not because it brings capital, especially in the environment of lower oil prices where you have less capital domestically, but it also brings a know-how. Now, FDI has, as Garbis has mentioned, has been low in this region. I think there's been 3 factors behind this. One of it is global. We have rising protectionism globally, and that doesn't just impact trade, but it also impacts foreign direct investment, and our region has been impacted by that as well. I think the second reason why you have a slow FDI in the last few years is because of slow growth. Capital will be attracted to growing economies. Non-oil growth has declined here in the region, and therefore capital is not so attractive for foreign capital to come here. And I think the third reason is the structural issues, the long-term issues, the stuff that we talked about in terms of the labor market and in terms of foreign ownership laws that you have in this region. So I think a mixture of these 3 factors is why you have weak FDI inflows into the GCC.
How about the escalation of tensions in the region also? Do you think that's a factor?
That's probably
Political.
must be a factor that people take it in. But this region has always been eventful in terms of
Yes.
geopolitical events.
Yeah.
So I think you mentioned the Middle East. To outside investors, they talk, they think oil and geopolitics. So
Yeah. Luke, let me turn to you again about investment, more from the foreign investors' point of view. How foreign investors see the region? Maybe you could distinguish country by country a little bit more on the portfolio investment.
Sure. Well, good afternoon, everyone. I know this is the session before lunch, so it needs to be a bit more interesting, I think, or we get a bit more controversial. I don't want to be controversial. I think the best thing to say is that if you look at investing from a portfolio standpoint, there is going to be a framework, a checklist that you need to go through. And the checklist will say, okay, number one, in terms of time, past, present, and future, what does the opportunity set look like? No word of a lie, it's extending and it's getting bigger. The second issue is relative to relative to other.
you're too interesting, Luke.
Can you hear me if I speak up? Okay, so relative to other parts of the world, there's obviously a comparison in terms of value and in terms of risks. The third thing to consider is the opportunity set. The GCC as a portfolio opportunity set has been very narrow. It's been banks, it's been energy plays, not that much really over the last 15, 20 years. The risks and the challenges have already been alluded to. Some are geopolitical. Mostly from a portfolio standpoint, it's going to be about liquidity. And finally, what you do is you take all these things and you rank these choices. You rank them by risk reward. And my experience over the last 5, 6, 7 years has really been on the credit side, looking at this region from the credit opportunity standpoint. Corporate credit, lots of opportunities there, very highly rated names, offering good yields, improving their yield curve. So this has been a big growth opportunity. From the equity side, there's an enormous attraction with regard to the dividends that are offered, but it's been a very heavy bank/energy related play. There isn't that much diversification. What I would say is that global investors are under-invested in this region. Whether it's from the credit side or from the equity side, it's very, very clear. If I want to raise one thing that's a little bit more sensitive, I think the Aramco IPO, there was an opportunity to go global. I think if I were an advisor, I would have said maybe a bit more patience on that one, to have opened up the opportunity set to a global world, to a more global minded investor base. And the final thing to say is that just as this year sets in motion this G20, there will be a lot of focus here. There'll be a lot of visitors, a lot of participation. This is a really great opportunity to showcase all the portfolio opportunities that are there. I think there is just almost too much emphasis on the FDI side. There's too much emphasis on the oil side. A lot of work is being done there now. So investors should be looking at other streams. Where is the opportunity set for alternative energy? What is actually happening on the point that was made by the IMF on sustainability and equality, and big moves are being made there. So I would say, this is really a great opportunity for global investors to take a look at what's out there. And I think it's going to be a combination of credit and equity, and I think there are large opportunities.
Can
Thank you.
I add a
Yes,
few
go
comments
ahead.
to what Luke just said, which is very important, because when we talk about diversification, often we get bogged down with the share of the non-oil economy to total GDP, or fiscal revenue, whether non-oil revenue is increasing and at what sort of pace. But what's also very important is diversification of sources of dollar revenue. And if we rewind a little bit back to 2016, when SAMA's FX reserves were really in the press as declining at a very fast pace before Saudi went and tapped international markets and started raising debt when it was still focusing on domestic debt, it's very important also to realize all the financial deepening that has happened since then, and how important it is to attract these financial flows and these portfolio flows, which are as important as FDI, if not more, as Luke is alluding to, in making sure that this region has a diverse pool of sources of dollar funding that it can tap to when oil prices decline.
Carla, Lebanon is a hot topic now. Everyone is speaking about what's happening in Lebanon. what are the origins of the crisis? What caused this sudden explosion in Lebanon? The economy is collapsing, the financial meltdown. How you see that?
So I'll tackle first the dollar liquidity shortage, the dollar liquidity crisis. And first, to dot the I's and cross the T's, I just want to say that the dollar liquidity crisis that Lebanon is facing today is not a product of the social unrest that erupted in October. Obviously, the social unrest did not help and exacerbated the challenges that were already there. But this is a crisis that's been in the making since 2016. It's been a slow-moving crisis since then, when really we saw that what kept everything together in Lebanon, which is deposit growth, went into a slow-motion slowdown. So what I mean by that is that at any point in time in the last 10 to 15 years, if you looked at the numbers in Lebanon, if you looked at the macro indicators or the debt metrics, you would have called the debt crisis, for a very long time. For a very long time, Lebanon's debt was dubbed as unsustainable, and people were calling for a debt crisis. But the fact of the matter is that the Lebanese authorities have established a track record of having never defaulted. And the way that they manage this is through deposit growth. So essentially, Eurobonds external debt is largely held domestically by the commercial banks, which are in turn funded by the large diaspora around the world. So in 2016, for the very first time, we saw a sharp decline in deposit growth from the non-residents amid the presidential vacuum of the 2-year presidential vacuum, when Lebanon could not manage to elect a president, essentially, in 2016. Ultimately, the president was elected in October, but in the summer of 2016, right before deposit growth went negative and we started seeing deposit outflows, the central bank, endeavored into some unorthodox and unconventional financial policies and monetary policies to make sure that they would raise interest rates and continue attracting dollars into the system to keep this virtuous cycle ongoing and to avoid the default. So this has been ongoing since 2016, since deposit growth started declining from there in a slow motion slowdown, and this is where we are today. So I just wanted to make it clear that this is not a crisis that we suddenly woke up to because of the social unrest. It's been a long time in the making, and ultimately the authorities have to make a decision now, actually this week, on how they want to proceed with their debt.
Yeah, I mean, most countries which went through this experience, they ask for financial assistance or IMF program. But so far, there are no indications that the authorities will request an IMF program. Why? What's the reason?
So there seems to be a reluctance on the ground by the local authorities in reaching out to the IMF. And it might be understandable that a country that has never had to seek help from the IMF, it may find it difficult to now reach out to the IMF, get help, and implement reforms as such. Because this is a country, we've dubbed it as the debtor moral hazard, where it's a country where authorities have never had to implement reforms because they have always received deposits and liquidity from the diaspora. So now that this liquidity crisis is sort of new to the authorities, they are finding it difficult to come out and reach out for an IMF program, especially that also they've always had help from abroad, even beyond the diaspora. So the international community in the recent past used to be supportive of Lebanon and of the sort of foreign aid that Lebanon used to receive. So suddenly, it's a situation where deposit outflows are a reality. Lebanon doesn't really have any more friends when it comes to bilateral support, and the only lender of last resort at this stage is the IMF. But you know that you have to deliver, very serious reforms that you have had a challenge in implementing in the last couple of years since the CEDR agreement in Paris. And this is the combination of challenges that the authorities are facing in really reaching out to the IMF for a real full-fledged program.
Yeah, one related question, Luke, about the amortization which is due in March 7th, about 1.2 billion, the amortization on the Eurobonds. And there is talk in Lebanon that most likely they will not pay it or they will default. What are the consequences of that?
Well, first of all, let me make a comment. When talking about a country that is at this very sensitive and dangerous time, I think everyone needs to choose their words exceptionally carefully when talking about a country like Lebanon right now. The second thing I want to say is we as an investor are not involved. We don't have any positioning at all. But dare I say it, time is not on their side. With regard to the sensitivity of the payment in March, I simply don't know. I do know there are people that have bought these bonds and are waiting for them to get paid off, and I do know that other people sitting there saying, look, this shouldn't happen. This is a question of will and wallet. Do the Lebanese have 1.2 billion to pay that? Cash is probably there, it can be paid, but do they have the willingness to pay this because of the consequences of going forward? Lebanon has an enormous debt sustainability problem. And paying this payment doesn't necessarily remove that problem, it just postpones the decision to do something further down the line. How do they avoid a restructuring or a reprofiling? It's going to be very difficult, but dare I say it, there is redemption in the process. I don't believe any country can always maintain an utterly clean, default-free, debt-free, problem-free profile in its history. Most countries in the world have gone through some kind of profiling problem. The most important thing about this process is that it be accepted, that it's going to happen, and there needs to be some kind of controlled resolution. This has to be orderly. So my issue, not just as an investor, but as a human being, is for everyone involved in this just to remember there will be a human cost. So I would urge everyone just to remember the humanitarian side of all of this and understand that when a country reaches a crisis point like this, it's not about just getting this next coupon payment, but it's about how this country deals with debt sustainability and gets itself back to a position. Now, with or without the IMF's help, there needs to be some kind of solution here. And all I can say is that the IMF has been involved in other countries around the world, most notably and recently Argentina. That has not worked. So wise minds need to really think about this. Remember, this is a very sensitive time, there is a human cost, and there has to be an orderly process to get this right.
Do you have any comments on that?
Yeah, I mean, I'd agree largely with what has been said. The crisis has been in the making in Lebanon for a number of years. And it's not just the debt crisis. You know, Lebanon has one of the most indebted countries in the world. Debt to GDP is higher than 150% of GDP. They pay 10% of GDP in interest payments alone every year. So there's a clear fiscal issue there. But there's also a currency issue there. You know, Lebanon has run a current account deficit in excess of 20% of GDP for most of the last decade. And if you look at any other country, you'd think, you know, that's completely unsustainable. And it certainly is. It's stopping now. So there's also a currency issue. But these problems are, you know, they have occurred in other countries. It's a common thing to get a fiscal crisis, to get a balance of payments crisis. That's why the International Monetary Order created the IMF, is to resolve these issues. And the solution is to have some form of debt restructuring and some form of currency devaluation to address the current account. But I think it's also important to take a few things into account. One of them is you need international capital to go into Lebanon to ease the transition. The transition is going to be painful, so you need some international capital to go there. And importantly, to avoid a recurrence of the crisis, you need to improve governance in Lebanon. The same survey, they asked people what are the biggest hurdles doing business in the GCC. They asked people in Lebanon. And governance is clearly an issue. People complain about an unstable government, unstable policy, corruption, and lack of infrastructure, all related to governance. If you solve it now and you don't address the governance issue, 5 or 10 years down the road, you're going to run into the same crisis again.
Tim, do you have any?
Yeah, I would just echo what Ziad just said. I think the other dimension that's been missing in some of this conversation is the political dimension for Lebanon. I mean, clearly, IMF packages are painful, but they're even harder when you don't have a cohesive government, and a government that is going to work on behalf of the people with the support of the people. Egypt went through a terrible IMF process recently in the last few years, but it had a strong government that was willing to take painful decisions and force the country through that process. I'm not sure in the case of Lebanon whether that situation applies.
Since you mentioned Egypt, I mean, Egypt had a successful program with the IMF for 3 years. They unified the rate. Growth is around 5% for 3-4 years. The fiscal and the current account deficits narrowed. But the way ahead, I mean, what needs to be done to sustain a growth rate around 5% or so? Because part of the growth in the past 3 years were related to specific factors like recovery of tourists from a low base, increase in gas production. So either Ziad or Tim, what are the challenges that the Egyptian economy is facing to sustain a growth rate of 5 or more?
I think, if you look at Egypt, yes, you have growth rates that you mentioned close to 5%, but most of this growth has been driven by government action and government intervention in the economy, new infrastructure, all good things. But the private sector is not really kicking off, and it's not really contributing very much. If you look at purchasing managers' surveys, they show that the PMI, the non-oil, the private sector activity in Egypt remains resolutely below the 50 mark, and even after recovering from the bottom of the sort of post-IMF program, it recovered fairly consistently, 50 mark with any consistency. And probably getting, reducing the a lot of activity in Egypt. I think that is.
Yeah, there is a question from the audience on Lebanon. It says, what is the contagion risk in the event if Lebanon defaults? So on the wider MENA region, is there any relation? I mean, in the region we have, I think, Egypt with high debt, about 95% of GDP. Egypt is doing well. Jordan, that is also around 100% of GDP. So Bahrain's debt is very high. Do you see any contagion in this context?
Well, I think maybe contagion might be in relation to population and the impact it has on the local population and the spillover into the difficulties that they experience spilling over into neighboring countries. I think that would be the contagion I would think about, rather than simply on the basis of who has which levels of debt to GDP.
Yeah, I'd agree with this. Lebanon has such a unique economic structure that's similar to other countries in the region, and therefore the fear of sentiment, contagion from sentiment to other countries in the region is probably low. It's unlike one GCC country gets into trouble, then you can see the possible contagion to other countries. But Lebanon is very unique in that sense.
Yeah, moving back to UAE, Tim, since 2014, the real estate market is declining, and it's on continuous decline. It's almost now 5 years, and the prospect doesn't look good. Why? What's happening? And what are the measures that the government or the central bank is taking to slow this process of decline in real estate prices?
No, I think the price decline is reflection of both sides of the equation. It's a result of oversupply, and that supply, anybody who's been to Dubai recently will testify to the continued construction and supply increases of property underway. And the other side of the equation is demand, and demand has been sluggish in the UAE and in Dubai over that period of time as well. So you are looking at a classic sort of pincer movement in terms of real estate prices in the UAE. Our observations are that private sector consumption has declined as a percentage of GDP over the last 10 years in the UAE, down from around 50% 10 years ago to around 30% today. So private consumption, private demand remains pretty challenged at the moment. And yes, there's been a few cuts in interest rates, but I don't think in the scope of the the issues facing the region, be they geopolitical or be they other structural issues, I think those are, those rate cuts are probably not sufficient to generate any upsurge in demand. Jobs, ultimately what you need to get the demand side fixed is probably an increase in population. And population, as far as we can see, is pretty much unchanged. If at all, it may even be declining. It's hard to say, but for growth to occur and for growth to be driven by the private sector, it needs population growth. And at the moment, there are very few jobs. The PMI surveys for the UAE and Dubai are pretty consistent in showing that job markets remain pretty neutral, no real job creation. So in order to get the growth going, you need to attract people from overseas to go live in the UAE and in Dubai. That, I think, the job creation usually fulfills that role, but at the moment it's not firing. So you have the two sides of the coin: supply, oversupply, limited demand. Yes, there is some attempt to try to rationalize and bring supply a little bit under a bit more coherent sort of approach to when properties come onto the market and managing that process. But up till now, it hasn't really benefited the price. The price year on year, real estate prices are down around 15% and have been that way for the last 2 or 3 years.
Mhm. Again, on the UAE, I mean, we note there are some indications that growth is slowing down, particularly in Dubai, most likely significantly less than 2% for this year. Do you think that the UAE or Dubai in particular reached its limit and they have to find other sources of growth, let's say knowledge economy, and in that context probably they need a more competitive exchange rate to come up with new sources of growth?
Well, I think they need they know that they need new sources of growth. I think Dubai and the UAE does know that and it recognizes that. But I think the challenge is trying to find what those are going to be. I think the emphasis, there is increased emphasis on manufacturing to some extent in Abu Dhabi, on technology as well. The knowledge economy you mentioned, you need a lot of structural changes to make those sectors work and to be successful, to draw skilled labor in to perform in those markets is one aspect of it. So I think the exchange rate is a hindrance, I think, to activity. Probably amongst the GCC countries, it's Dubai and the UAE, which probably feels this is the most sensitive to the exchange rate and the strength of the dollar that we currently have, because it has more exposure to the outside world, to trade and services, and anybody, again, who's been to Dubai recently will probably testify to the expensive nature of a lot of the retail activities there, retail spend there. So I think the exchange rate is part of it, but it's not the whole story. And I don't think, from a GCC point of view, there's necessarily going to be any change to the exchange rate regime. Most countries probably are, the exchange rate is less of a factor than it is in the UAE's case.
Ziad, do you have?
I'd agree with this. I think the exchange rate is part of the story, but probably not the full thing. Where I would disagree, so you talk about the UAE, and it's the most diversified economy in the GCC. And if you look at the numbers, it's probably right in the sense that the income that the UAE gets from selling oil and gas is not, as a percentage of total income, is lower than the rest. But if you think about the UAE role, and particularly Dubai in this region, it's a hub, and it's a hub. While it doesn't sell oil and gas, it sells financial services, other services, tourism, real estate, and so on. Its client base, their incomes are based on oil and gas. It serves this region, it serves the GCC. And if the GCC's income declines, then certainly the demand for what Dubai offers also would fall. So it's that role as a hub in this region, given that this region has slowed down significantly since 2014. Non-oil GDP growth fell to a third, from 6.8% to about 2%. Naturally, the role of Dubai as a hub for this region will suffer as well, and you get a growth slowdown. So the question is, what do you do then? Do you transform your role as a hub to a wider region, or do you try and find something else to do?
Yeah, one last question from the audience. I think this is for you, Luke. What is the role of Ashmore Asset Managers in the March Eurobond? I mean, Ashmore is one of the biggest holders of Eurobonds, probably.
Let me repeat what I said
Yes,
at the top of the
yes.
discussion. This is a very, very sensitive time,
Yes.
and I would not comment on any other firm's business and how they operate and what they're doing. Like I said, we're not directly involved in this event, and I just wish everyone well. So I'm going to decline to answer that question.
Well, we are on time. Thank you very much. Please join me in thanking our panel.